What's up, traders? Welcome back to Invest with Henry. Today, we're diving into the world of option trading and ranking 20 popular strategies, the top tier A all the way down to F tier, where the worst strategies land. For an option strategy to rank highly, it needs to tick 3 crucial boxes, okay? Number 1, the profit potential. If it doesn't offer a good profit potential, it's going to be an F tier, no exceptions. Number 2, risk management. It should have a balanced risk profile. High risk without corresponding reward is a no-go. 3, ease of implementation. It should be straightforward to execute and manage, even for those that are not advanced traders. After ranking 20 of the most popular strategies from S for super down to F for failure, I'll crown one strategy as the best of the best, raising it to S tier plus, and one that is the worst, sending it to F tier graveyard. Let's dive in. First up, the covered call. The strategy involves holding a long position in a stock while selling a call option in the same stock to generate income. It's effective, straightforward, and can enhance returns in a neutral to slightly bullish market. The big strength is income. And the biggest strength of all is the consistency, because you can do it on a weekly basis, a monthly basis, on a quarterly basis. A covered call, you can't really lose, because the worst that can happen is you end up losing the stock. Now, we will also talk a little bit about rolling later on in this video, but with a covered call, you can keep rolling it higher. So it's a very versatile strategy, has a really good income, consistency. Now, the downside is you can limit your upside, okay? So in a very bullish market, if the stock is basically going up a lot and you've sold a covered call, you may miss out on some upside. Now, that's not necessarily meaning that you're gonna lose money, but you're missing out on some potential upside because it requires a large amount of capital. I'm very tempted to put this in the S tier because I'm going to consider the average investor's portfolio size, so I'm actually going to be putting it in A tier. So let's jump into the second strategy, which is going to be a long call option. The long call option strategy is straightforward. It's buying a call option, betting the stock will rise above the strike price before the expiration, or at least at expiration, you want it to be past the strike price plus the premium that you paid so you can break even. This strategy offers a high profit potential, but it can also be risky if the stock doesn't make the expected move that you're hoping it's going to make. So when you're buying a call option, you want the stock to rise pretty quickly or within your time period until expiration. The biggest strength of this position is that you get a really big leverage factor. I've seen many of my students that have bought call options for $1, $2, and that call option ends up being worth $9, $10, $11. So they're able to 4x, 5x, 6x their money, even 10x their money in a short amount of time. But the downside is that direction has to be very correct, and not only has the stock has to go up at a pretty fast pace, it also has to go up a certain amount. So if you're buying an out of the money call option, it can be pretty risky, because if you buy a call option that's 10% of the money, you need the stock to go up 10% in that time period. So the time period is 30 days. Well, you have 30 days for the stock to rise 10%. So that's one of the negatives, and you must pay to enter the position versus collect income like some of the other strategies on this list. So this is a high risk, high reward strategy, especially during earnings. So I'm overall going to be putting this into B tier. Okay, so we're gonna put this into B tier. And the reason is because you can make a lot of money very quickly. However, you can also lose a lot of money quickly. So if you're not right on direction, you end up losing money. So this is gonna be in B tier. Now, strategy number 3 is going to be the bull call spread, okay? The bull call spread involves buying a call option at a lower strike price and selling another call option at a higher strike price within the same expiration period. I'm gonna link some videos down in the description below so you can see more videos on each and every single strategy. It limits potential losses and profits a lot if the stock goes up. This position right here only costs, $100, $200, or $300, as you can see. The best is this strategy gives you upside like a call option, but it's cheaper given that you're selling one call option and buying another versus just buying one in our previous strategy. A bull call spread can definitely squeeze out a 2x return or more in a short amount of time. And although I don't love this strategy completely because it requires spending money, I can't ignore how strong it is. This will be the first strategy that I'm actually going to be putting in S tier. This is not common, but this is going to be an S tier strategy given how little money you have to put up and how much money you can make as a return. So we are going to see if this strategy will become the one and only S plus tier, or if we have some better strategies coming up. The fourth strategy is going to be a long straddle. This is something that I haven't really covered that much on my channel, but here's what a long straddle is. This strategy involves buying both a call option and a put option at the same strike price and same expiration date, betting on high implied volatility, or just in general, high volatility in the stock. So if it moves down a lot, you make money. If it moves up a lot, you make money. It's a great way to profit from significant price movements in either direction, bearish or bullish. So with this strategy, you're expecting for a very big move in the underlying stock. I personally only like this one for earnings moves or stocks that are very volatile. The strength is you don't need to know direction to profit. The weakness is you need to have significant volatility. Otherwise, you will not recoup the premium paid to open both a call and a put option both at the same time. The good news is you can manage the position fairly easily and cut it for a profit in a very short amount of time, making this a pretty good strategy overall for aggressive investors, and also making it a lot easier to manage since it's very flexible to just open and close this position. In fact, oftentimes I do see some of my students open this position and close it in the very same day. This is not a strategy that I would want to use with a lot of money because, well, essentially it is on the riskier side of options trading strategies. And for that reason, I'm going to be putting this into B tier, although I am tempted to put this into C tier, given how investors typically buy long straddles when the market is exciting, and that's actually when volatility is higher than usual. So that actually means that most investors are actually mistiming the market, making this a more advanced strategy, especially when it comes to timing. However, I will leave it in the B tier because it's a position that isn't too hard to manage and can actually cut on the same day or the same week of opening. The next strategy, the fifth strategy, I'm going to be looking at naked put writing, okay? So uncovered naked put writing. This is a strategy of basically similar to naked calls. However, naked puts also carry significant risk if the stock price plummets. The margin requirements can be very substantial and the risk of substantial losses is way too high. Unless you use margin, which is more advanced strategy that is towards large portfolios, naked puts are just not really that viable for the average investor. I'm tempted to put this in D tier, but I will actually put it in F tier because the vast majority of people cannot execute this trading strategy at all, unless you have a bigger portfolio, in which case this strategy can actually be put into A tier. But I'm going to be putting it in D tier because for the majority of people, and basically if you're not advanced, even if you had a lot of money, this would not be the most ideal strategy because it puts you into too much risk. So you really have a hardship with risk management on this position as well as just way too advanced. So let's get into strategy number 6, which is a protective put, okay? The protective put involves holding a long position in a stock and buying a put option to protect against downside risk. This is a great strategy for preserving capital while staying invested. However, buying options on a long-term basis, according to this research article right here, you can see that it just honestly doesn't make a whole lot of sense. If you time the market before a crash, you can make insane amounts of money on a protective put. But in most cases, you're going to probably miss time buying protective puts. They're very good for bear markets, but they're not that good for bull markets. I will place this in the C tier for its effectiveness in risk management, but overall cost and long-term drag on portfolio performance means this strategy is simply not profitable. It is only good for hedging. So from the hedging perspective, and because this is a good strategy to have a little bit of your money in, if the market is bearish, also can protect your portfolio very well, I'm going to be placing this strategy in the C tier. Okay, the next strategy I'm going to be talking about is the Iron Condor, strategy number 7. So here we have an Iron Condor. This strategy involves selling an out of the money put and an out of the money call while buying further out of the money puts and call options. It creates a wide range where you can profit from low volatility. This is a top tier strategy for consistent results. Right off the bat, I personally like it because it is a selling strategy that profits from both selling calls and puts. This makes it a very powerful strategy. The downside is that basically this strategy has 4 option legs, which can make it very hard for managing a position. However, an iron condor, when you're selling it, is very powerful for sideways action. So if a stock isn't really moving anywhere, you can make a boatload of money by selling iron condors. In fact, this is actually one of my very favorite strategies. The only thing I don't really like about it is the management of this strategy. If you have many iron condors open, you really can't deploy a whole lot of capital because you want to be diversified. You may only want to put 5% of your money in an iron condor. So this can get a little bit tedious in terms of amount of positions that you have, although basically you can see a profit of like 10, 20% per month or even more by running an iron condor selling strategy. However, if you're going to be doing it on volatile stocks, you'll get paid a lot more, but at the same time, volatile stocks are volatile for a reason. So again, when it comes to managing this strategy, it can be very difficult. However, I will say because it's a small account strategy and you can put in a very small amount of money and have a really big reward, I'm actually going to be putting the iron condor in the S tier. This is an S tier strategy given that you can make 10 or 20% returns per month consistently, as well as basically having small positions. That really only downside is managing and closing the position, since it is harder because it has a bid-ask spread. The bid-ask spread of 4 options is going to be harder to close than just one single option. So the next strategy is going to be a calendar spread, okay? Now, let's talk about a calendar spread. This strategy involves buying and selling options of the same type, whether it's a call or a put, with different expiration dates, but at the same strike price. It's excellent for capturing in time decay, and it can be very highly effective. A calendar spread, also known as a time spread or horizontal spread, involves the simultaneous purchase and sale of 2 options of the same underlying asset with the same strike price, but different expiration dates. This strategy can be implemented using either calls or put options. I haven't covered the strategy in detail on this channel yet, but calendar spreads benefit from the difference in the rate of time. The rate of time decay between the short-term option and the long-term option is specifically how you make money. The short-term option decays faster than the long-term option, potentially allowing the trader to profit from the differential. Calendar spreads offer flexibility and can be adjusted as the market moves. For instance, if the underlying asset's price moves significantly, traders can roll the short-term option to a different expiration date or strike price to better align with this market outlook. Whatever their market outlook, they're able to actually adjust the position, which actually makes it pretty good for management. As they reach expiration, there is some management you do have to do because one leg expires and you may have a naked second option if you don't open up a new position or close out the first one for a new one. Given the work and extra complexity compared to some other strategies on this list, I'm going to be placing this strategy in B tier. The 9th strategy I'm going to cover is going to be the uncovered naked call writing, okay? So we've talked about naked put selling. Now this is going to be naked call writing, okay? So with this strategy, I am straight up not a fan of this strategy at all. First, it offers unlimited risk because if the stock price skyrockets, your losses can be absolutely massive. This strategy generally requires a large portfolio, limiting many investors. Now, I'm not going to lie, I have made some money on the naked call strategy. However, I've gotten into lots of trouble. Specifically, I made a big mistake with some technology companies. Luckily, I didn't really do much naked call selling. So even myself, who's been trading for a decade with lots of experience, this strategy ended up being unprofitable for me. Granted, I didn't do it for a number of years. I've only did it for about 9 to 12 months. So this is a high stress strategy that doesn't really justify the potential reward. So I'm just gonna place this in F tier and I won't waste any time explaining more about this. Strategy number 10 is going to be the long put option. So the long put involves buying a put option, betting that a stock will fall below the strike price before expiration. This is a little bit different than the protective put, because a protective put means that you do have this stock, and when you buy a put option, you're sort of protecting your stock. So if that stock falls, you have a lot of protection. A simple long put just means that you're speculating for a stock to fall down. You don't necessarily have that stock. So this is a good way to profit from a declining stock market. It's good to profit from stock prices declining, but this carries similar risk to the long call option. You need the stock to go down in a certain amount of time. And if it doesn't, you end up losing money. I generally learned at Goldman Sachs that buying straight up options isn't very profitable, but this strategy could be good for hedging your portfolio, as it's a very similar or almost the same strategy as a protective put if you have the same stock that you're buying a put option on. So I'm going to place this in C tier. Now, next strategy number 11, is going to be a short straddle. The short straddle involves selling both a call and a put option at the same strike price without owning the underlying stock. It can result in large losses if the stock price moves significantly in either direction. It's better than F tier, but this strategy isn't really that good because it has a whole lot of risk, and I generally just don't prefer it compared to other strategies like the S tier iron condor. So given that this is just an inferior strategy to iron condors, in my opinion, unless you have a very large portfolio, which again, this is not going to be friendly for the average investor, I'm going to place the strategy in D tier. Strategy number 12 is going to be the collar. A collar strategy is basically a solid risk management tool, especially if you're holding a long stock position. This strategy limits both gains and, well, it limits losses, which is the best part of the strategy. So it makes it a very balanced strategy. Although you don't want to necessarily limit gains, this strategy makes your trading a lot more consistent. And actually, this strategy alone, the collar strategy, will make stocks safer than, options safer than stocks, because a stock can move up and down, but a collar strategy adds income to the stock. And a collar is basically just a covered call. There's not that much difference. The only difference is that it is an in-the-money covered call, meaning that you're creating a collar, like right here. So let's say the stock is at 100, you can create a collar at 95, okay? So if you have sold a 95 covered call, you're basically gonna really protect yourself. And even if the stock falls by 5%, you're gonna be okay, plus you're collecting income. So the primary benefit of a collar is the downside protection, gives you cushion, gives you a margin of safety, and overall, it provides your position with more balance. So a collar strategy is going to give your portfolio less volatility. And also, the collar strategy is an effective hedging tool, allowing investors to preserve capital by mitigating large losses in the underlying asset. This is actually a very popular strategy that I saw used all the time at Goldman Sachs, because typically a high net worth individual has some experience on the CEO level. Maybe they have had a big exit from a company. They have had a stock exit, right? The company went public and they own a lot of stock. So a collar strategy actually reduces the risk from an investor. And this is something that Mark Cuban did when he sold Yahoo, sold the company to Yahoo for, it was like billions of dollars. So he ended up using the collar strategy. So this is the best, literally the best strategy to use, especially as you scale your portfolio, but it's also very useful for small portfolios. So by selling the call option, the investor receives a premium, which can provide an additional income source, right? And this is very beneficial in a sideways or mildly bullish market where the underlying stock, the underlying asset, does not significantly exceed the strike price of the call option. I also have a video on the double dividend strategy. I'm going to drop that down in the description. The double dividend strategy is basically using the collar and using dividend stocks to collect huge income. I'm going to be putting this in B tier unless you like low risk and want to have a fixed income, which for the majority of people, they are using options to grow their portfolio a lot faster. And the collar strategy, although it's very good, very effective for retirement, it's also very effective for reducing risk. It's not necessarily going to bring in the huge income of 3, 4, 5% and so on, right? The iron condor can make 10% per month. Covered calls can do 4%, 1% a week, 4% a month. This strategy is probably not going to have as high of a return. That's why I'm going to be placing the strategy in the B tier. Unless you are mega rich, then the strategy makes a lot of sense and it could be A tier. Strategy number 13 is going to be the iron butterfly. The iron butterfly is a more complex strategy that can yield very high returns if the stock price remains relatively stable. However, its complexity and the risks makes it a much less attractive strategy as opposed to other strategies on our list. An iron butterfly is an advanced option strategy designed to profit from low volatility in their underlying asset. Again, I'm going to link a video on 50xing your money because with this strategy, you can literally 50x your money. However, the downside is that the amount of management, the multiple option contracts, and generally how difficult this position is to get absolutely perfect is very difficult. However, this strategy is also the highest option trading strategy in terms of return, period. Again, you can 50x your money, you turn $10 into $500 using this strategy, but closing out this strategy, difficult. 4 legs on this strategy, pretty hard, can be costly. So overall, I think there's so much benefit to the iron butterfly, but there's also quite a lot of risk, and it does take a lot of time to manage. So I'm going to be putting this strategy in C tier because it's very good for small portfolios, it's very good for fun, it's very good for high returns, but in terms of managing, it is F tier for management, and high returns and stability is good. So I'm going to be putting this in C tier. Next strategy is going to be strategy number 14, the bull put spread. Okay, bull put spread involves selling a put option at a higher strike price and buying another put option at a lower strike price within the same expiration period. It's a good strategy for moderately bullish outlooks. Okay, it's also what I refer to as the put credit spread. I typically go for a $5 width on these. Out of the money option selling absolutely works. That's the number one rule that I have, period, for making money consistently. So you can lose everything that you want if you don't pick the underlying stock correctly. But the thing is, I always have a good watch list of stocks that I cover in my Discord community. I'm always watching the top stocks. I know exactly where their support level is. And almost all the time, I'm going to be winning on the put credit spread strategy. So I'm very actually tempted to put this in S tier. However, given that a put credit spread can't give you the huge returns, it can, but it's not going to give you the huge returns like a call option can, like a bull call spread can. It's also probably not going to generate as much as an iron condor, since an iron condor gives you money from both calls and puts. This is just one side of the iron condor, which is a put credit spread. I'm going to have to put this in A tier, although I'm very tempted to put it in S tier because if you use put credit spreads on high quality stocks, you can absolutely have a very consistent return of 5 to 10% per month. So just barely going to be an A tier. Now, the next strategy 15, is going to be a long iron butterfly. So the long iron butterfly strategy involves higher potential rewards, but also higher complexity and risk, as we discussed with the short iron butterfly. This is a decent choice because you spend a little bit of money and then you can make a lot of money. But again, the management is so bad. I'm not going to waste too much time. I kind of want to put this in F tier, but I'm just going to put this in D tier because you can get a really good return. The next strategy is going to be a ratio spread. The ratio spread involves buying a certain number of options and selling more options of the same type and expiration date. While it can be profitable, it carries significant risk if the stock moves sharply. So the ratio spread, it's basically more complex. I don't really like this strategy. I don't even cover this strategy because it honestly doesn't fall into my consistent income strategy. So I'm going to have to place this in D tier, although I wanted to put it on the list because I want you to know all the strategies that there are out there in the world of option trading. Now, next strategy is going to be strategy 17, the diagonal spread. The diagonal spread involves buying and selling options of the same type, so calls or puts, with different expiration dates and different strike prices. It's a flexible and potentially very profitable strategy. The construction of a diagonal spread, though, is a little bit difficult. So saving the complexity of constructing a whole diagonal spread, I'm just going to skip this strategy because for me, this is still going to be in the D tier. So guys, before I continue on with the video, I want you to comment down below, what is your favorite strategy? Which strategy have you used that you have gotten the most consistency on, or which strategy have you used to get the biggest results with? The next strategy for strategy number 18 is going to be the broken wing butterfly. This strategy, along with other butterfly strategies, doesn't really make any sense. I'm going to be putting it in D tier. Strategy 19 is the long put butterfly, long put broken butterfly, which again, guys, there's many butterfly spreads out there in the market. But for me, Butterflies in general, I'm just going to be putting in D tier. Now, the next strategy is going to be a synthetic long stock. So there's actually something really interesting because I don't usually talk about synthetic positions on this channel. Synthetic positions are basically used to arbitrage in the market. So what I mean by that is you can actually create a synthetic long stock strategy, which involves creating a long position on using options by buying a call option and selling a put option. So if you buy a call option, you sell a put option, you actually create the same risk and return exactly as a long stock. There's absolutely no difference because you're spending money on a call option and you're basically selling a put option, which subsidizes the call option perfectly. So you basically have a zero cost position, but it moves up and down just like a stock would. So you have the same risk. Generally, I would say this is just holding stocks. There's not much point of this. I'm just going to put it in C tier because it's neither good nor bad. The next is going to be a synthetic short position. Now, there's actually a benefit of a synthetic short position because, well, you probably don't want to short a stock because you end up having unlimited risk and you also have to basically pay interest. A synthetic short stock position also involves buying a put option and selling a call option, which is still unlimited risk. So it's not that good, not that much better, but at least you don't have to pay interest. So this is still going to go in D tier. Now, the next strategy is going to be a ratio call right. The ratio call right involves holding a long position in a stock while writing more call options than the amount of stock owned. This can be particularly risky if the stock price rises significantly, leading to large potential losses. So I'm going to put this in D tier. The next strategy is going to be a box spread, okay? A box spread is theoretically risk-free. It can be costly due to commissions, the bid-ask spread, and slippage, making it a very poor choice for investors. Given that you're not an algorithmic trader, most likely you're not watching my channel because you're an algorithmic trader. You're probably watching this channel because you want to make consistent, safe, passive income. You want to make option trading another income source and potentially leave your job, which is what I teach all of my students how to do in my Discord community. The box spread is not going to be conducive to that. It also doesn't really have that much reward. So I'm going to put this in D tier. So we have a whole big D tier. Are you ready for this? I'm going to crown the best in the worst strategy. If I had to crown just one strategy as the best of the best of the best, you get what I'm saying, right? It would be the Iron Condor. Selling the Iron Condor is S tier plus. It offers a balanced risk reward profile and consistent returns, making it the top pick for S tier plus. On the flip side, the worst is going to be well, you guess which one was the worst. The uncovered naked call right, because the market is bullish long term. So if you're selling naked call options, probably not going to go that well unless you pick trash companies with a very bad balance sheet. However, you have unlimited upside risk. So F tier will be the naked call option. So there you have it, folks, my ranking of 23 most popular option trading strategies. Whether you're new to option trading or an expert or experienced trader, I hope this video helped you choose the best strategies to maximize your returns and manage your risk. Don't forget to leave a thumbs up if you enjoyed this video, subscribe, and I'll see you guys in the next video.